The Consumer Price Index, also known as the CPI, is always one of the most important measures reflecting the health of the US economy. In today's financial news, we will delve into the latest CPI inflation data released on July 30, 2025, evaluating the key movements and their impact on the economy, financial markets, and the lives of the American people. First, let's take a look at the most notable figure, the US Consumer Price Index, CPI, for June 2025 increased by 2.7% compared to the same period last year. This is the strongest rise since last February, clearly reflecting the return of price pressures after a few months of easing earlier. Notably, this increase has surpassed some cautious forecasts made previously, surprising the market and investors. Why has the CPI increased again like this? Two key causes have been identified. The first is the prices of food and energy, the two factors that always have the highest volatility in the CPI basket of goods. According to the latest data, food prices continue to rise, increasing by 0.3% in June alone. Notably, energy prices rose by 0.9%, with gasoline prices reversing sharply, from a 2.6% decrease in May to a 1% increase in June. This volatility in gasoline prices has a ripple effect not only on transportation and travel costs, but also on most other sectors of the economy. But that is not all. Behind the overall figures, core inflation, that is the CPI excluding the two highly volatile groups of food and energy, also increased by 2.9% compared to the same period last year. Although this figure is slightly lower than market forecasts, it still indicates that there is significant underlying price pressure in the current US economy. Another highlight that cannot be overlooked is the role of new trade policies. Starting from early August, the United States will officially impose a 30% tariff on many imported goods from the European Union, EU, and Mexico. This policy, recently announced by President Donald Trump, aims to protect domestic production from foreign competition. However, the direct consequence is that import costs will increase, leading to rising prices for consumer goods and raw materials. Experts predict that this will be one of the factors driving inflation even higher in the second half of 2020. So how do these moves affect the monetary policy of the United States Federal Reserve, also known as the Fed? In fact, hotter than expected CPI data immediately impacts market expectations about interest rates. According to the latest data, the probability that the Fed will cut interest rates at the end of July meeting has surged to 97.4%. Clearly, investors and financial circles believe that the Fed needs to ease monetary policy to support the economy amid inflationary pressures and the impact of new tariffs. However, Fed officials remain quite cautious and maintain a wait-and-see stance. The reason is that they want to more clearly assess the actual impact of the new tariff levels on the economy, as well as the inflation developments in the coming months. Hastily cutting interest rates before truly controlling inflation could cause long-term consequences, especially when the prices of essential goods, such as food and fuel, have yet to show signs of cooling down. From a broader perspective, the return of inflation in the US in mid-2025 is the result of a combination of factors. In addition to the rise in global commodity prices, the impact of supply chains not fully recovering after the pandemic, and especially the new tax policies, we are also witnessing political and economic instability worldwide. These fluctuations directly or indirectly affect commodity prices, transportation costs, and production expenses. For Americans, rising inflation means that the prices of essential goods and services continue to escalate. From gasoline, electricity, food, to everyday consumer products, all are affected. Workers and families with middle and low incomes are the most heavily impacted, as daily expenses make up a large proportion of their total income. The cost of living increasing faster than the actual wage growth can erode purchasing power, affecting consumption, which is the main driver of the US economy. For businesses, especially those with international supply chains or heavily dependent on imports from the EU and Mexico, rapidly rising input costs will reduce profit margins, forcing them to adjust selling prices or restructure operations to maintain competitiveness. In this context, American businesses will face a difficult choice: either accept reduced profits or pass the cost pressure on to consumers. further prolonging inflation. The financial market is also not outside this whirlwind. Investors are closely monitoring every move of the Fed, every CPI figure released monthly. When expectations of interest rate cuts rise, the stock market often reacts positively in the short term. However, in the long term, high inflation can erode asset values, increase borrowing costs, and create unpredictable fluctuations for both the stock and bond markets. In addition, the US dollar is also under certain pressure. High inflation, along with the possibility of the Fed cutting interest rates, often causes the dollar to weaken against other major currencies. This can support US exports, but also makes imported goods more expensive, continuing to contribute to the inflation spiral. Looking ahead, financial experts agree that inflationary pressures will persist in the coming months, especially as new tax rates officially take effect from August 1. If price control measures are not effectively implemented, we may see the CPI continue to rise in the third and fourth quarters of 2020. However, it is also important to emphasize that inflation at 2.7%, although higher than before, is still within a controllable range compared to past hyperinflation periods. This is a time when monetary policymakers, businesses, and the American people need to remain calm, closely monitor developments, and proactively adapt to new fluctuations. On the Fed's side, the possibility of adjusting interest rates in upcoming meetings remains under consideration. If inflation continues to rise rapidly, the Fed will have to balance between the goal of controlling prices and supporting economic growth. The Fed's wait-and-see approach is reasonable to avoid hasty decisions, but it does not rule out the possibility of swift action if the situation becomes more serious. In this context, the advice for investors is to diversify their portfolios, be cautious with assets sensitive to interest rates and inflation, and closely monitor policy signals from the Fed and the US government. For businesses, optimizing the supply chain, controlling production costs, and improving operational efficiency will be key to overcoming the upcoming period of volatility. For each family and consumer, it is necessary to proactively adjust spending plans, prioritize essential expenses, and take advantage of promotional programs and discounts from retailers to reduce the impact of inflation on daily life. In summary, the economic news on July 30, 2025 presents an overall picture of inflation returning in the United States with many intertwined factors, from gasoline and food prices, new tariff policies, to expectations about the Fed's interest rates. The actions of financial policymakers will continue to be the focus of attention for investors and society as a whole in the coming months. Let's continuously update on new developments, listen to expert recommendations to make wise financial decisions, and protect personal and business assets against the unpredictable fluctuations of the US economy.